Hi there, how are you? Happy St. Patrick's Day. I'm Carrie Gatto, and I'm with Keller Williams Realty in the Cambridge Somerville office. And I'm presenting a webinar today titled How and When to Sell an Investment Property. And we do have a little bit of St. Patrick's Day theme going on because it's March 17th, 2022. So today, the subtitle is How to Find Your Pot of Gold. Thank you so much for watching. Before I dive into the content, just want to let you know a little bit about me if you don't know me yet. So obviously I'm a real estate agent. I've been working full-time in the greater Boston area for going on 12 years. Yeah, since 2010. And I've been with Keller Williams for 6 years. And because I've been based out of Somerville, but also have definitely grown to serve the greater Boston area, I've enjoyed working a lot with investors, sellers of investment properties, people who are just getting started. And I say I do investment-minded real estate because I like to always keep it in mind for people to feel empowered and confident that they can build wealth in real estate. And after all, as you know, if you're watching this, it is the best vehicle for building wealth, right? So, sorry, I just have somebody joining. So today, we're going to be focusing on that investment side, particularly from the side of potentially selling an investment property. And I just want everyone to know that I'm open to questions. Feel free to use the chat box or simply unmute yourself. Let me know if you have a question as we go along. And because the market, as everyone knows, has been so crazy lately, I thought we'd just start with a quick market update of multifamilies in Massachusetts. So what I'm showing here are some statistics year over year, comparing year-to-date numbers from today from this time last year. So just going through the chart, listing units, the number of listings available on the market today for multifamilies in Massachusetts has gone down year over year, almost 14%. And that's a significant number. And I think it's even more significant when you figure in that, you know, the pandemic was really at pretty much almost its height last year at this time. People were only just starting to get vaccinated and there was still a lot of quarantining happening. So if some towns, including Somerville, weren't even allowing tenant occupied properties to be shown during the quarantine period. So the fact that it's even lower today is pretty outstanding. So inventory is tight. It's very, very tight. And days on market has also decreased a little bit, 4.44%, so that the average days on market is currently 43. And anything less than 6 months for that data point is considered a seller's market. So just over a month is very fast in the broad scheme of things. And if it's priced correctly, most properties are selling a lot quicker than that. This is just an average. And then next we have the absorption rate. And this has gone up over 50% from last year. So we're currently at a 121% absorption rate. And what this number is measuring is how quickly the available inventory is being absorbed by the buyer demand. So the higher the ratio is, the more quickly the inventory is being absorbed by the market. And so it's actually a future predictor of prices. So when there's a higher absorption rate, it means there's more demand than there is supply. So we all know that when demand outweighs supply, prices trend up. So it's an important statistic to know about because you can predict what's going to happen for prices. So as you can see, it looks like prices are going to keep going up for the near future anyway. Months of inventory is down. So again, tight inventory. It's down by about a third currently. Although we're starting to see that pick up a little bit. It's the beginning of the spring market, and we're starting to see a little bit of uptick in inventory, thank goodness. And then the average sale price for multifamilies in Massachusetts is up over 11% from last year. So it's currently 641,602. And again, that's statewide. If you have property in the greater Boston area, you're probably looking at a much higher average sale price than that. Now, this is a pretty crazy statistic to think about. So over the past 5 years, the average sale price of a home in Massachusetts has increased by 50%. So that's the average over the past 5 years. And, that's because we've seen double-digit appreciation in the past 2 years, even during COVID. With the low interest rates and the tight inventory situation that we've had. And even before that, it's been a really hot seller's market. So, I mean, if you own property in Massachusetts, well, yeah, you are lucky. I mean, nobody could have predicted this kind of appreciation over 5 years. So let's just take a moment to count our blessings. I mean, that's incredible. So that brings me to this question, which is, how much equity do you have in your property? Do you know what your property is worth right now? If you haven't had a market analysis in the past 6 months, chances are you might not know how much your property is worth. I never would want people to rely on Zestimates, Zillow or things like that. Those online algorithms, they're not accurate. Most of the time it could be quite a ways off. So because algorithms don't, they've never been inside the property. They don't know what improvements you may have done, or, the intricacies of different streets in a certain neighborhood, or what things are coming to the area that, a website or an algorithm possibly couldn't know about. So definitely it's important to keep up and get a market analysis, know what your property is worth, and therefore how much equity you have in your property. Because with the high appreciation rate that we've been seeing, there is a high equity buildup. More Americans have more equity in their homes than pretty much ever before on average. But obviously this double-digit appreciation, this high appreciation is not sustainable. It has been caused by the low interest rates. That's been a big factor, as well as the tight inventory and the incredible high buyer demand. It's not going to last forever. Most experts are saying that it's going to start to balance out this year. So that remains to be seen, but it's obviously not going to last forever because markets cycle up and down, and that's just what happens. I think that it will probably continue to be a strong market going forward the rest of 2022, just based on those numbers we just saw. But I think that the appreciation rate will slow down to a more normal balanced market, because interest rates are supposed to edge up. They already have edged up, and they're supposed to do that more. That's what we expect. And also, as more inventory does come on the market, that will help absorb all that buyer demand too. So if you do have a whole lot of equity in your property, this presents an opportunity to leverage that equity that's just sitting there, or cash out, or sell it. And here's what I mean. Here are some options. So one option is the 1031 tax deferred like-kind exchange. A lot of investors I know are using this great tool right now to upgrade their portfolios. They're saying, well, I have all this equity sitting there. Now is a great opportunity to roll that equity into another real estate investment, so that, maybe I'm going from like a 2 or 3 family into a 4 or 6 unit building, or from a 6 unit building into, 10 unit building, whatever it might be. And because they have all this equity, they're going to be able to put a really healthy down payment on that bigger property, and have the opportunity to increase their cash flow, increase their net worth, and all those good things. So with a 1031 tax deferred like-kind exchange, you sell the current property and roll part or all of the proceeds into a new property. And you get to defer the capital gains tax indefinitely, which, for an investor, taxes are like the biggest expense in most cases. So this is a huge opportunity. And with a 1031 exchange, you have 45 days to identify a new property, and you can identify up to 3. And then you have 180 days, inclusive of the 45 ID period, to close on one of those properties. Now, I know a lot of times people get scared of those timeframes and they feel like that's going to be a lot of pressure. 180 days is quite a significant time. That's 6 months. So it's likely you'll find something that works for you in that time. But if you're still not comfortable with that time frame, you actually can make your sale subject to finding a suitable replacement property. And that's not uncommon in a seller's market. And that just means that you have the freedom to accept an offer, but you don't have to close or schedule a closing until you have identified and even gone under contract on a new property. So you are really in the driver's seat. You're not under any pressure. And if you don't find a property that works for your needs, you can actually cancel the contract. So yes, it might not work for every buyer out there, but again, because the market's so lopsided right now, chances are you'll find buyers that are willing to agree to that and still willing to pay a very, top of market price, because there's just not enough inventory to go around. So people have to kind of be flexible these days if they're looking to buy real estate. And also with the 1031 exchange, you can purchase a property anywhere in the United States. So, Massachusetts, and especially the greater Boston area, is a very expensive location. But you could look out west. You could look at any number of the so-called Zoom boom towns that are exploding in different areas like Tennessee and North Carolina, where remote workers are, basically moving to these communities, and they're just exploding populations because the cost of living and the housing is so much cheaper there. So those are great opportunities for investors, and personally, I know that I have really great resources for different areas of the country that, again, are cheaper to live, cheaper housing, and there are property managers there that can take care of your properties for you, and it can be a very passive real estate opportunity. So, think about that. Maybe somewhere else in the U.S. would be a great place to allocate some of your proceeds. And any type of real estate can work for a 1031, not just residential, but also commercial, Delaware State Trusts or DSTs, and other pooled assets as well, just as long as it's an investment. Even like a short-term rental, you could purchase something and use it 2 weeks out of the year. Last time I checked, but make sure you check with a specialist, because I'm not a CPA or a tax deferred 1031 specialist. But last time I checked, you could use a vacation home 2 weeks out of the year, and it would still qualify as a rental, as an investment property. So that's even an option potentially as well. We already talked about making it subject to finding a suitable replacement property. You definitely want to make sure that you use a qualified intermediary. And I have a great person for you, Lynn Bagby. She's amazing, and she does other webinars with me, and I can make an introduction if you'd like to find out more. She's very, very willing to give information and educate people. But yeah, you need to use a QI or qualified intermediary. Very important to protect your money. And then the other option I mentioned is leverage. So if you're sitting on a boatload of equity, like a lot of Americans are right now, you could also refinance and pull some cash out of the property, or use a HELOC or home equity line of credit, and then use that as a down payment to buy other properties. You can acquire additional properties, or even depending on where you're buying, maybe you can even pay cash And again, you could look at the long-term buy and hold opportunities that are available or coming available, and even the short-term rental market too. The Airbnb market has really exploded since COVID, as people are more inclined to stay at a private residence rather than hotels when they go on vacation. And remote workers too are using short-term rentals in some destinations around the world. So it's an interesting opportunity there. And then, of course, you could just cash out. There's your pot of gold. And there's nothing wrong with that, I mean, if you've been an investor for a long time, then you've done what investors should do. You've bought low, and now you have the opportunity to sell high. And again, we don't know what's going to happen with the market. Nobody has a crystal ball, but it has been going up for 10 years or so, and typically market cycles run 10 years. So we may be due for a correction, but I can say that Massachusetts is number 7 of the outbound states, meaning that more people are moving out over the past year than are moving into Massachusetts. And there's only 6 more states that people are moving out of more so than Massachusetts. So it's not a drastic difference. I think it's like, there's a report I can share with you later, but I think it's like 54% are moving out and 45% are moving in, or something like that. But still, it does over time, that could put more pressure on the housing market, or less pressure, depending on how you think about it. Also, rents are high now. Rents have actually gone up significantly in the past year. So that could mean a higher sales price for you. And maybe that is a reason that sale prices have increased, is because obviously an investor is looking at this as a business, and they need to see cash flow. So the higher the cash flow from the rents, then the higher the sale price that they can justify paying. And, again, if you have been a landlord and have been maintaining properties yourself, that's a lot of work. So if you cash out, that just means less maintenance and more time freedom for you to enjoy the fruits of your labor. You could reinvest those proceeds into a more stable vehicle. And I think I have a couple of those on another slide. Real estate, it is stable over the long term, but if you're thinking of selling in the next 5 years, then maybe this is a good time to say, well, I don't know when the peak will be, but then again, we don't know the peak of the market until after it happens. So why not get ahead of it, cash out now before it's too late, and then invest into a more stable vehicle like bonds, or maybe the DST vehicle that I mentioned before, which have a lower return but are less risky. And if you're getting older, any financial advisor will usually say that's when you want to turn to less risky types of investments. And I know the big concern here is if you cash out and sell, you're going to have taxes to pay. And yes, when you make money, you have to pay taxes, but it's better than the alternative, which is not making money. But think of it this way, the market is kind of paying the taxes for you. I mean, these inflated sale prices are basically covering the differential that Uncle Sam is taking from you. So if you think about it that way, you're still making out on top. You are still the winner. And yes, just the market is paying your taxes. Okay. And again, none of us knew how crazy the market would get. So let's just all pat ourselves on the back and say, wow, we are lucky. Luck of the Irish. Just wanted to talk now about some of the ways that you can measure your rate of return on your current investment holdings and see if it makes sense for you to keep them or to do, cash out, sell, just switch things up, maybe roll into another property. So one of the best measures or the most popular measures that real estate investors use to assess their investments for profitability is the cap rate, which is pretty simple to calculate. It's just the net operating income, which is the revenue, the rent revenue from the property with any expenses deducted, but not your mortgage. So it does not factor in loan payments, mortgage payments, or any financing. But any other expenses are factored out of the revenue, and then you have your net operating income. And then you divide that by the market value of the property, right? So as market values have increased so significantly, chances are your cap rate has probably decreased because it's a converse relationship. So if you take that number, that ratio, and that's basically your rate of return on your investment, your real estate investment. Compare that to rate of return you might get with out-of-state holdings, as I mentioned, because they usually will have a lower market value and maybe comparable rents depending on where you're looking, or even higher rents. Maybe, I don't know. I mean, you'd have to see. Compare that to those potential rate of return or cap rates, and then the Delaware State Trust option, which I have a great contact for you to talk to if you're interested in that. But that's a more, it's a real estate investment, but it's more passive because you're pooling with other investors, and your money basically will be invested into a stable, usually commercial, I believe, property, and it will be so the property will be already stabilized and very very reliable rent roll, and there'll be no maintenance needed for years and years and years on this property. And so you'll receive less than you would if you own the property individually, but it's also much more passive. You don't have to do anything except for collect the checks. And then when they sell, you get a portion of the profit, the proceeds. So that's something to look at. And then, other kinds of ways that you can share portfolios with other investors, even things like Fundrise. I don't know if you've heard of that, but there are different opportunities out there that are more passive, but they're also real estate. So you can do a 1031 exchange, but have a passive, less risky income from those real estate holdings. And then there's commercial real estate. That's also an opportunity to think about, because a lot of commercial real estate has gone down since COVID. And, depending again, where you're looking, what type of commercial real estate it is, there may be an opportunity there where you think, okay, I can buy it low, and then as business increases or people come back to that space, and there's more demand, the prices should go up. So just think about the cap rate you have now. What is it? And then compare to some other types of investments. Or if you, like mentioned earlier, do a 1031 into a larger building, what would that look like? Because now you have more tenants, more units sending rent your way. Maybe you can upgrade. So now, if you think about risk versus reward, so with residential property ownership, it is somewhat risky, right? Because, you have tenant solvency. Maybe you get a bad tenant, you have to evict them, or you just have people leaving, and you have, you have to fill a space, you have vacancies. You also just, the risk, because it's a physical building, and it requires maintenance. There might be things that have to be done in the near future, the location, the status of the property, what's going on in that neighborhood, and keeping it maintained. All of those things present some level of risk. The term and structure of the tenant's leases. if you think about, you know, do you have tenants at will? Do you have 1-2 year leases? And how does that affect your plans to possibly sell the property? Now, right now it's March. Most of the leases in this area turn over in September. So if you are thinking of selling and you have a September turnover, now would be a good time to actually take action, because when you sell a property, you want to make sure that buyers have flexibility with the tenants. You want to make sure that if they want to vacate one unit and live in it, they have the opportunity to do that, because a segment of your buyer population are going to be owner occupants. Or if your rents are not up to market value, then the new owner will want to make sure they have the opportunity to raise the rents when they take ownership. So yeah, so the leases run with the property, so you want to take into account how the timing of the leases and the other terms will affect the desirability of your property and how many buyers will be interested based on those. And then the overall market, what's going on, the dynamics that we just kind of covered, and any macroeconomic factors too. There's a lot of uncertainty in the world right now, and that's definitely one factor to think about. And I think real estate has become even more desirable through that uncertainty. As we've seen, the market has exploded. So yeah. And then less risky alternatives. So I kind of talked about this a little bit already, but government issued bonds are one of the safest investments. They're lower return because of that. But again, if you're moving towards retirement, then that might be attractive. You want to have something that's stable, predictable. I think they're usually, the return is something 2, 3, 4%, something in that ballpark. And then I've mentioned the Delaware State Trust already. That's a really good option to look at, because you can do the 1031 into a Delaware State Trust and defer the taxes as well. Plus, it's a stable investment, a passive investment. And then, of course, there's like mutual funds, which can be very safe as well. Oh, so I was just going to mention too with this slide. So if you take your cap rate from the slide before and you compare to the return that you could get for one of these less risky alternatives, you're probably going to find that the real estate cap rate is a little bit higher. There might be a spread of 1, 2, 3, or even 4%. I don't know. I don't know your numbers, but that differential represents your reward for taking the risk for keeping the money in the real estate. So that's where you have to say to yourself, okay, is the risk of keeping it in real estate right now, knowing that we might be near the top of the market, worth that differential? Is it, if it's just 1% or 2%, maybe not. But if it's more, then, maybe it is. So that's how I would suggest looking at that. And then there's just opportunity costs. And basically what this means is, if you are thinking of upgrading your portfolio for a higher return right now, and you're sort of sitting on the fence and not sure, second guessing yourself, whatever it might be, what's that opportunity cost of waiting? We know that interest rates are going up. So if you're going to be using any financing in that next purchase, then you have to factor in the opportunity cost of, how much more expensive could it be when interest rates go up? It could, if you're talking higher price point, then that could be a huge differential. So it might prohibit you from getting into a property that you're thinking that you can afford now if you wait till next year, if you wait 2 years. Because, on a larger property, like, $700,000, let's say, that even like 1 point in interest rate makes a significant impact on your purchasing power. So there's that. And then, of course, just what could 1, 2, or 3 years of increased rent and therefore increased net operating income mean to your net worth? And that's really the number one thing you want to think about in terms of your wealth building is your net worth. So if you had the increased cap rate or the increased income coming to you from a bigger property, how could that affect your net worth if you do it now versus waiting a few years? Other considerations, of course, lease cycles, like I touched on before, and making it a tenant-friendly process. A lot of times when I talk to investors who are thinking of selling a property, they're very concerned about the tenants and their experience. And, nobody wants to, make the tenants mad, make them uncomfortable, or worst case scenario, have them move out because they're upset. And that's a very valid concern. So because I am experienced in selling investment properties, I've created a system of communication with tenants that makes them feel very comfortable and kind of gets them on our team. Because after all, we are all on the same team. Everybody wants a smooth, less intrusive process. Everybody would prefer it kind of go quickly, and less showings is always a good thing. So if you're interested, I can share with you what my tenant-friendly process is for marketing and showing and ultimately selling an investment property. And of course, leases run with a building. So the new owner will have to honor any leases that you have in place. Those are legal contracts. And it's always good to remind the tenants of that too, that if they have a lease, it will not be threatened by a change of ownership. It will stay intact. And that often will ease some concerns. Of course, if they're tenant at will, then that would not run with the building necessarily. Whatever, I think it's 30 days notice for a tenant at will, unless it's otherwise specified. But if they do have a lease, it will definitely run with the building. And of course, major repairs, in this market, another good thing about it being such a hot seller's market is you can sell pretty much in any condition, as long as it's priced right. But if you do have major repairs to be done to the building, then you need to factor those in. Well, you either need to repair them before selling the property, or you need to factor them into your anticipated sale price. So that's probably pretty obvious, but just a consideration. So yeah, so next steps, I would say get a market analysis, know what your anticipated sale price, your market value would be. And if you want to reach out to me, I'd be happy to do that. In fact, I don't even necessarily have to get into the building to give you at least a ballpark. But of course, getting into the building does help make it more accurate. At least one unit would even help. And I can also give any advice on things that might need to be done to improve the marketability if you're interested in that. But like I said, you don't have to do anything in this market because really it's just such a high. So do that first. Just figure out your market value and therefore your equity in your property so you know what you're working with. Then talk to your CPA so you understand the tax consequences if you were to sell, and your options with that. Make sure you have all the deductibles in line and you get that whole picture, and touch base with your financial advisor and see what they have to say about going forward with a sale. That's why your financial advisor is there, so definitely have that conversation. And then if you're ready to claim your pot of gold and move forward, this is a great time to do it. So I would definitely take advantage of the times. It's a very unique market, and it definitely won't last. Okay, so I'm getting a little bit of, oh, okay. Are people, thanks Yvonne, I appreciate that. Are people fleeing Massachusetts overall or primarily in the greater Boston area where rent is higher? That's a great question. I don't know. I've only seen the stat. I've only seen that stat as regards to the whole state. So I don't know if it's more, Greater Boston obviously has a higher population than most other areas of the state. So I wouldn't be surprised if, it was more people actually leaving Boston because that's where most of the population is concentrated. But I haven't seen that breakdown yet. Do you think that multifamily housing prices will crash before they level off or just gradually keep rising, then level off? Yeah, I'm not anticipating a crash at this time because the demand is so strong and the inventory is so incredibly low. And this is across the board for multis, singles, and condos that the moment if the prices were to dip, there's a whole slew of buyers that are just waiting for that to happen that would then jump into the market and be motivated to buy. So that would again, that underlying demand would keep the market prices at least stable. Or, if it dips, it would be very little. I don't think it would be a crash per se. Also, the crash that happened back in 07 was in large part due to the fact that there were all those faulty mortgages that were made, right? They would give mortgages to anyone who had a pulse, which led to all these foreclosures happening, people defaulting because they really couldn't afford the payments. They weren't properly qualified. And so that meant that all this inventory just swamped the market and overran the market. So it just goes back again to supply and demand. When there was too much supply, it meant that pricing crashed. So we don't foresee that happening again because the mortgage industry has gone through a major overhaul. And right now it's actually, it's a lot to get a mortgage. They really kind of put you through the ringer. And they're definitely making sure that people can afford their mortgages. Plus, like I mentioned, people have an incredible amount, the homeowners have an incredible amount of equity right now due to the appreciation. So foreclosures or slew of foreclosures is not likely. So I do think that they may taper off, prices may taper off or keep rising, but at a less of an appreciation rate. Right? So it won't be like double-digit appreciation as much as it was over the past 2 years. It will be a more normal appreciation, which in a healthy, stable market, it's 5%. So I could see that continuing forward or a little bit higher, but maybe not like the crazy appreciation rate that we've seen in the past 2 years. Okay, and then you said, what is the average cap rate nowadays that investors are getting for multifamily properties? Yeah, it really depends on the area mostly. In Greater Boston, the cap rates are lower because the prices are high. So it's hard to give an average because it just is so dependent on where you're looking. And if mortgage interest rates exceed the cap rate, would it be worth buying an investment property in the short term versus long term? Not sure what that means exactly, but I always am a believer in buying investment property for the long term because then you can ride out market cycles. That's why I said that if you're thinking of selling in the next 5 years, then now I would think be the time to cash out rather than waiting because we may be coming up on a market cycle. But if you're not thinking of selling in the next 5 years, if you're planning to hold longer term than that, then maybe it won't matter because you'll ride out a market cycle anyway. So yeah, I'm a big believer in the long-term buy and hold, and great questions. Number 5, do rents seem to be continually rising, or do you see any softening? Investors paying high prices for properties, but rents lowering or leveling off is not sustainable. I mean, as of right now, they've been on the rise. But again, I don't, it's hard to predict the future. I don't know, but it seems like kind of prices of everything have gone up recently. Just inflation, I guess, and other factors as well. But yeah, they've definitely increased quite substantially in the past year or two. Hopefully they won't keep increasing, because obviously that isn't sustainable, like you said. But that's what's been happening so far. Thank you for the questions, Yvonne. Yeah, so that's kind of all I have today. But if you have other questions or would like to schedule a consultation, please reach me via email or by phone. I am more than happy to chat. This is what I love talking about. And I do also have a book called You Can Have It All with Real Estate. So if you or someone you know is interested in getting started in investing, I would love to send you a copy. But thank you so much for watching. I really appreciate your time. Thank you, Yvonne. And hope to see you or talk to you soon. Have a great day. Bye.